Is the Southstart episode, given we're doing it from Adelaide.
Yes. I was going to say live from our hotel rooms, but it's pre-recorded.
Live and up. We shared what we've been enjoying with Southstart. It's still going. We've got another day, so we're heading out there.
Discussed a bit of listener feedback. Jack does, in fact, still have a girlfriend. But then we followed up with a few charts and discussed Bitcoin.
And we touched on Employment Hero, having a bit of a tiff with Hostplus and some in employment platforms.
We talked about Elon also hitting out at OpenAI and wanting to see them, which you'd probably be a bit of a grumble bear as well, as you had a $50 billion pay packet knocked out. And then the lawyers who won that case then asking for $6 billion.
And then we touched on an article from One Ventures, which breaks down the venture debt myths.
Breaking down some misconceptions that I've certainly had. So that was really great.
Then we talked about this data set that you found on these charts about VC interaction with pitch decks as a bit of an indicator of what we're seeing too, that deal flow is up, investment activity is up, and more VCs are looking at more pitch decks.
That was some really smart content marketing. So we unpacked that. And then we did some rapid fire, going through some Australian raises that have occurred recently.
And then touched on how long it takes to get to a certain point of investment. This was a LinkedIn post from Peter Walker from Carter.
And led into a chat about the use of ESOPs and the importance of getting them right. And also a little bit of a chat about secondaries and when is the right time to actually offer a secondary.
Hopin, despite getting to a multi-billion-dollar valuation and the founder taking nearly 130 million pounds of secondary dollars off the table, Hopin didn't survive and went into a liquidation. And we talked about that, crossing the chasm and the need to niche and how to do it effectively. Being still Southstart, we're going to also head off to a winery. Let's start the episode. We are all in Adelaide, yet instead of organizing a meeting room or something where we could be in each other's company, we're sitting in different rooms recording a podcast.
Don is probably, 3 meters that way.
It's on the other part of the wall. Jackson home. Good planning.
Yeah. Oh, it's good to be in Adelaide though. And far out, the weather's been amazing.
Yeah, how good. Quite warm, quite dry. It's been putting it on. Thank you, Jack.
Yeah, it's been super warm. I'm opting with shorts. I'm not wearing jeans today. It's way too hot.
I didn't bring shorts, unfortunately, so I'm going to be still rocking out the long pants.
Yeah. But how good has Southstart been? Like Daniel and Craig just continue to make this better and better every year. And it's just absolutely phenomenal.
And it's Danielle plus her little one, which has been so cool to see.
Yeah. How good is it? Like she just makes it happen while holding like less than 1-year-old. Just amazing. Yeah. Shout out to Danielle and Craig. Like well done. Another amazing event. We still have another day of it today, heading out into the vineyard country. And for those, if you're a listener and you haven't been to Southstart, it really is unlike any other startup conference or event. It's really not a conference at all. It's a couple of days of hanging out with cool people, doing cool things and having combos. And because almost everyone flies in for it, no one goes back to their desks or back home at the end of the day. Everyone's here for a good catch up.
Yeah. And there's still content to engage in and learn from. And then it's creating relationships with people that you know of in the ecosystem, but you've never met.
Yeah. We've been a group of fanboys this week, meeting all these people that we admire and catching up with everyone. And Don, you got to catch up with Rain Wong.
So for the listeners that are not aware, the first time we mentioned Rain in an episode, and he's an absolute legend of the ecosystem. So I called him Ryan, of which he then politely pointed out that it's Rain. And then in the last episode, I managed to get it right, Rain Ong, but in the show notes called him Rain Wong, to which he did a very funny post wanting to talk to my manager about the second time I'd screwed it up. But I managed to get a picture with Ryan Wong, also known as Rain Ong, and he was, absolute legend. We had a good chuckle and he said anything for the podcast. So.
Rain is awesome. He's just hilarious. It's such a pleasure to actually meet.
We should actually change the name of this to Incompetent VC rather than Transparent. But that's more. Well, but then whilst we've been down here, the show must go on. I think we're transferring funds for a deal today. So that's really exciting. And we've got one that will launch on Monday. So a lot happening in the ecosystem.
There is a lot. The other big news that got announced at Southstart was that the South Australian government is funding 10 places for founders of SA-based tech companies to join us on our UK and US missions this year.
Woohoo!
Pretty stoked. So the South Australian government supported us last year with 10 sponsored places for the UK mission. And this year it's 10 across both our UK and US missions. So applications just launched. You can check it out on the website. But if you're a South Australian venture, like a tech company, particularly if you're B2B, or if you're a South Australian founder, please do check it out. Jump online. We'd love to see you on one of the missions.
Yeah, and for the other South Australian founders that have been on the missions, they'd be really great to have a chat to what they got out of it. And we're going to be running some online events to explain why come to one of these things. So I'm really looking forward to meeting a new cohort.
Yeah, I can't wait. It's always amazing the companies that get discovered in this process. So looking forward to it.
Yeah.
I think we mentioned this last week, but deal flow is up in volume and quality. It's really impressive to see the companies coming back to market this year and straight out of the gate, very busy with new deals, which is great.
Yeah, we'll talk a little bit about some of the data is that we're seeing. So that'll be good. And then we arrive back on Friday, and then Monday we're having that event at my place with Boo. So I'm really looking forward to that.
I said we need a name for a collective of 50 investors sitting around a campfire at Dom's place.
In the middle of March when it's 30 degrees, I think the collective noun of that's fucking stupid. Like, anyway. And then what was really cool, I must admit, was just bumping into people that actually listened to this podcast, which was really great. And we got some really great listener feedback prior to Southstart as well from Peter Ellis out of Brisbane. Thank you, Peter, very kindly for some very, very helpful, very giving, just really helpful feedback. But one of the points was we often don't close story loops. We throw something out there, we don't come back to it. So we're going to make sure we do a better job of that, especially around some of the investing stuff we talk about and some of the trends. But Jack, actually, multiple people wanted to know, are you still in a relationship given the bullshit stunt that you pulled on Valentine's Day?
Yeah, still have Anna, still happy. All reports are good. But yeah, Valentine's Day was a good night. What I didn't say on air was we were trying to wear party shirts along to the dinner, and Anna refused to let me wear the party shirt. But when we got out of the car, it was a perfect timing. So when the other couple got out, it was all good. And I think we've locked in next year. So happy days.
Jack, did you do the whole fancy seeing you here?
Yeah.
Went up to it.
Michael Jamison, great ad.
And when Jack says it's all locked in for next year, the dinner that we had with Anna, I have a feeling there will be some conversations between now and next year. But I just wanted to loop back. We had done, I think, a couple of episodes ago, just sharing some charts around the sort of structural thing happening to the crypto markets, especially Bitcoin, with the legalization of ETFs that could then hold Bitcoin. What was happening is week after week, more and more money was flowing into Bitcoin and crypto ETFs. And those ETFs just have to go and buy, irrelevant of what the price is. And what I was putting forward there and saying is that there's just a structural flow, and it's continued. I think it hit record highs. Bitcoin is a high vol asset. So it then hit record highs and then very quickly dropped 10%, but now it's back up again to record. And in Aussie dollar terms, it's cracked the 100,000 Aussie dollar, whereas US just having a look at 66,000. So it's well and truly back, baby.
Wow. Yeah. It'll be interesting if it cracks the 100K US in this run. My kids have started asking about cryptos and Bitcoin. You know, there's an adoption curve happening when your young kids are starting to ask about it.
You can't use it anywhere. It doesn't actually have a proper use case, but for hodling, yeah, why not? There's the model, the stock to flow model that I talked about last time, which is really just trying to look at assets that have a big supply, but growing demand. What happens to those prices, whether it's property, whether it's digital assets, and different models have this run. If this run is like any of the other runs, we're talking about hundreds of thousands, but this is not a financial forecasting podcast, and nor are we here to market those kinds of things. So people do your own research, and all we're saying is that it's just interesting the amount of dollars flowing into ETFs and those ETFs have to go and buy. So if those inflows continue to grow, guess what's going to happen to the underlying asset? It's not rocket science, but I'll be doing a bit of hodling. And what's interesting, so there's another chart, like Bitcoin has been really good at sniffing out interest rate kind of thing in the past, but that's often what gold has been. Gold has been one of those hedges, and it's really been reactive to real rates. And gold has actually been moving up and to the right as well. It's hit a record of, in US dollars, it might be a little bit old, but like nearly $2,200 US an ounce. And so both of these sort of almost like hedgy protection, alternate kind of things are moving in the same direction. And so that's just, I think it's interesting. Now, I think more on the Bitcoin side, there's a bit of self-fulfilling prophecy, because if the whole world that is interested in that believes that this is a bull run and we've got the ETFs, like it just takes, whether it's a good asset or not, it just takes on a world of its own.
I think that's a good way of summarizing it. It's in a world of its own.
In a world of its own. This is why you shouldn't have your phone on during episodes. So the chippy that was going to finish the toilet that's outside of my place for the VUFN says, sorry, but my car has fully died. It needs a whole new motor, so I won't be able to do the job for you. Good.
Awesome. Days before the event.
Oh, okay. Right, for those companies, just for the record, it is a fully functioning bathroom. It's just that I had never quite finished it, and I wanted to ensure that it was a nice surroundings for those needing to use it. So the show shall go on, and there will be facilities. Anyway, I probably should edit that out. Let's get into some proper Aussie news and a little bit from US. Employment Hero has hit out at Hostplus, who indirectly, Hostplus is one of their shareholders, because I believe Hostplus has money with Airtree. Airtree's one of the shareholders there. But there's a parliamentary thing going on in this space. And Bronwen Clune put an article out. Hostplus has helped grow the Australian VC sector to what it is today. So it was surprising to see Employment Hero, one of the country's most liked startups, hit out at the super fund. And Simon Thompson of Startup Daily also put out an article as well, is that what Hostplus and other superannuation funds seem to be hitting out at is these workforce management platforms, which is what Employment Hero is. So you embed it into your business and it takes care of a whole lot of different aspects. One of the parts of these workforce management platforms is the ability for staff to choose their superannuation and to be able to change their superannuation through the life of employment. And there seems to be a bit of a barney on whether a workforce management platform should allow that. And is there any incentive for that workflow management platform to be churning people into other super funds? And are there dollars flowing in? That seems to be the crux of it. I don't know if you've got a different view.
No, I was trying to get my head around what's their positioning as to the why. What did they actually state a why somewhere other than protecting people from churning?
So what they said, we are concerned that the way many WMPs, workforce management platforms, have operated to date, and we believe will continue to operate absent of government information, proves that the software can and is being designed and implemented in a manner that undermines the superannuation system and harms employees. In particular, we remain highly concerned by instances of WMPs automating the fund selection process and designing that automated system in a manner that distorts and sidesteps critically important selection of an appropriate fund for consumers. Now, what Simon Thompson said in his article is, I'm telling you this to understand why Employment Hero's founder, Ben Thompson, was utterly triggered by one of his investors and ripped into them on Twitter. Tomo's taken a gander at the submissions made to Treasury when he stumbled across argument put by Hostplus, including that they run contrary to everything that he's trying to achieve. So in true Simon Thompson form, love you, Simon, and he thinks they're trying to fuck him. That's Tomo's argument.
And there's some solid accusations in there.
Yeah, so it's going to be interesting. Hostplus, I think Bronwen points out, I think the VC industry in the early stage scale up industry would be a different industry without superannuation funds that take a long-term view providing capital through it. here we've got obviously a fast growing business in Employment Hero that seems to have different view and different interests to maybe super funds who don't want their customers to churn. And so, without getting into some of the specifics, which I don't fully understand, what's going to be interesting is when successful company and investor come head to head, so publicly in this manner.
But we've seen a few pictures now in the embedded super space, and it's clear that's where we're heading, just because the workflow and how easy it is for the individual to onboard, give their details once, and then automatically transfer it across to the super account and then just easily select who they want. So it's just such an easy process instead of doubling up. But I can see from Hostplus's view, because to turn it on and off in between different superannuation funds becomes a really quick process.
And therefore they lose their stickiness.
Yeah. And also I'd imagine lose their stickiness, but also the capital inflows for a super fund manager to manage that capital. If that's an increasing percentage of funds under management is quickly being diverted, I can see why they're worried.
I think Hostplus as well in their submission is pointing to ensuring that what's in the best interest of the super holder, which means you probably need to have a range of information and data and understanding in order to make the right decision, as long as that's being protected. But yeah, this is going to be a complex matter. No incumbent is going to want churn, but at the same time, we want to be able to have customers that have choice. But when it comes to super and complex financial instruments and making sure that there is the right approach to it and the right support structures is incredibly important as well. Adrian Hunter, who's on the board of Employment Hero and has been a guest on our podcast and has agreed to come back on. I've just been incompetent in organizing the session, so I will absolutely do that. Adrian believes that super funds taking this approach is an attempted abuse of market power. So it'd be interesting to unpack that with him. And he talks about competition being good. It makes everybody perform better, and digital platforms can make it easier for employees to engage with super, both at the start and on an ongoing basis. And so I'll put a link to his post in there as well. But these kinds of things happen in the ecosystem when things change, right? So we're going through this digital revolution. We're going through the embedding and digitization. And when you get a new world order coming, and Jack, I think you're absolutely right, that new world order leads to different people with different interests, that leads to conflict. And so we'll see how it goes. But another person who seems to have conflict at the center of their DNA and likes to hit out all the time is Elon is suing OpenAI for breaching the founding mission.
Yeah. He's claiming that OpenAI has become a closed source de facto subsidiary of Microsoft, focused on making money instead of benefiting humanity, which there's so much irony in that statement coming from him. But so he's actually launched a suit claiming that they've abandoned their original non-profit mission that he actually co-funded.
And in Capital Breif's letter of intent this morning, there was a copy of a post on Twitter from Litigation God, and he put there, when the client goes rogue and starts tweeting settlement offers to the other side. So yes, Elon has started a suit, but then goes on to Twitter and says, change your name. If you change it to Closed AI, I'll drop the lawsuit. Now, in response to it, OpenAI went, just hold on a minute, and it published a blog on this week and gave access to all the emails of Elon's interaction with them and the fact that Elon wanted to make it a for-profit purpose, but he wanted control. He wanted it within Tesla. He wanted to be CEO. Tell me you're stuck in a kindergarten narcissist phase without telling me you're stuck in a kindergarten narcissist phase. So how do you know when Elon's lying?
The lips are moving. That line of change your name to Close AI and I'll drop the lawsuit, like coercive control, which just shows this is just about him, his ability to control the outcome rather than anything actually meaningful. And I've seen it play out before with him. Like hold him to ransom. I want control. I want to be CEO. I want this part of Tesla.
He's pissed because he's been left with a low margin auto company and not a high growth tech business. And now he's upset that other people are doing better.
Yeah.
Poor Elon. Having said that, capitalism is a bit of a funny beast and it can aggravate you from time to time. Did you see that the lawyers that successfully argued that his $55 billion or whatever remuneration package should be struck out, they are applying for their fees to be what equates to be about $6 billion. They want 28 million shares. I have a feeling that it's going to be a fraction of that because 28 million shares won't be worth that soon. But holy moly, lawyers, I think that someone did a calculation that equated to like 500,000 an hour or something.
I can't remember. I was chatting to at Southstart about the US, like just being so trigger into litigation at the drop of a hat. And lawyers there must just be cleaning up. And then you hear a story like this, like a $6 billion payday. It's like, how on earth is that justified?
Jack, you were explaining it the other day.
Yeah, I'm not sure the exact figure, but something like the rule of thumb was they get 1/3 of whatever they saved in fees. So the $6 billion is actually less than the typical rule of thumb, but the quantum was much larger than any precedent set. So no one actually knows what is fair and reasonable, but $6 billion for the time seemed absolutely ridiculous, but it's still less than the 1/3.
May I humbly submit that we probably know what is fair and reasonable, and I'm not sure 6 billion is fair and reasonable. I think what we're actually saying is we don't know what the precedent would allow the lawyers to get away with.
Yeah.
They normally get away with 1/3, I guess is what you're saying, and that's in these cases, that's been the historical average, but 1/3 would be more like 18 billion. And they went, because we're good lawyers, we'll take 1/3 of 1/3 and only 6 billion because we're just.
That's insane, isn't it? If they get $6 billion for this, far out. We're in the wrong profession, boys.
Considering both of you did law degrees and both of you could have been lawyers and you chose to get into this industry where we sit waiting for 10 years to work out if it's a zero or there's a return.
Oh, yeah.
It's not all about equity. The tractor team has been down at Southstart representing that part of the community, and that part is venture debt. So it's not just shares and equity. More and more venture debt is becoming something that is used. And One Ventures put out a post sort of clarifying some misconceptions around venture debt. And I must admit, I've been one of these people that having been burnt by debt in a previous life. One of the things I've learned the hard way is the problem with debt is you have to pay it back. And now I took out some fixed facilities that weren't fit for purpose with personal guarantees and all this kind of stuff, blah, blah, blah. What One Ventures have posted is actually these venture debt facilities are not infinite. They generally run on 2 to 4 years, and they only have very short interest only periods. And then they P&I down reasonably quickly. And so companies that are getting venture debt are only going to get it if there is a demonstrable way of paying that down. And so I've been probably a little bit negative saying, all of these companies taking on venture debt, there's going to be a reckoning. But actually, if the credit standards are to the high standards of One Ventures, and we had a really great session with them understanding their product, if the credit standards are upheld and the process is upheld, the people that can get access to venture debt are the ones that should get access to venture debt.
Yeah, that's a really good point. It was really refreshing actually hearing One Ventures and how they approach like their onboarding process and the process they go through in selecting the companies to work with and the standards that they have to meet. I think for me, I'm similar. Like I got burnt by debt, personal guarantees and all sorts of things, but the inventory financing that we put on was phenomenal for us. And that was a real growth catalyst. But I am naturally biased against debt, but I can see the models, and we're working with one of our portfolio companies now around a switch to HAS, which will require some financing to make that modeling work. And when you actually work through it, it makes a lot of sense. So I think it does depend a lot on the company. I think it does depend significantly on the provider, and shout out to One Ventures. I rate them incredibly highly. Yeah, I think so long as you do your homework, and again, going back to the comment Adrian DeMarco makes about having a business that you can forecast reliably will help you have that surety around models, like taking on models like this.
And whilst venture debt is becoming an option for a lot more people, there's still the equity market. And Harjay Kemps on LinkedIn put out some data that goes back to 2018 on pitch deck interest. So investor deck interactions. And he put the data from Dropbox DocuSend reveals an exciting trend in the venture capital landscape. Last week, while founder activity remained steady, investors have significantly upped their game. VC activity surged 21.74%, making an impressive nearly 43% increase year after year. And so this sort of data set is looking at what seems to be the DocSend function in Dropbox for early stage and VC. And it pretty well aligns with what we're seeing. We are seeing, like we said at the beginning of the show, a real ramp up.
Yeah, and what an awesome metric. I hadn't seen this before, but having that data, that's really interesting. It could just be that VCs are on the hunt and they're opening every slide deck possible to go through and view them and it's splicing the data. But based on what we're seeing, good quality deals coming through and the volume of deals is up. So it makes sense with what we're seeing.
Now, taking the back from Peter Ellis, let's just try and describe it. So the chart is over the whole year, broken up into weeks. And then it just shows the number of interaction in numbers of weeks, and it's just steadily been increasing. And then we obviously had a bit of a difficult year and now we're up. But what I also found interesting, which is something related to Jack and I's discussion this week around content, is that good content shouldn't actually feel like an ad. And this little helpful post was actually an ad for this guy's AI tool to review your pitch deck. And you put your pitch deck into the AI tool and then it gives you some feedback, which really is just lead generation for finding pitch decks and deals. But how is that intersection of something interesting, helpful, but at the end of the day, it was content marketing.
Yeah, brilliant strategy though. Well done.
We've been looking into this internally just to try and help some of the portfolio companies out with setting up their marketing engine. And some people I've been following on LinkedIn have been posting some great content just around how they view marketing. And one of the principles was the best ad never feels like an ad. And as soon as someone sniffs that they're trying to be persuaded, they get their back up and they're more reluctant. So yeah, we've seen some cracking ads where it takes you the whole 10 seconds to the very end to realize you've just been sold a product.
Yeah. And depending on the product, but everybody's defense mechanisms, your hackles come up when you feel like someone's going hard on a sell to you. But that doesn't mean that you don't want to buy. And so it's actually just finding these buying journeys. And even enterprise B2B, there is a space for content. There is a space for authentic storytelling that feels more like educational or something engaging than it does a hard sell.
Yeah. And something I've seen on LinkedIn, like what we know is it may not be the typical content marketing that works for an e-commerce business, but you look at some of the best marketers on LinkedIn, like Jessie Wu is a fantastic marketer for her VC, and it's all coming from long form written text. And she is getting amazing traction because she's providing really good value. Like that in itself is a great marketing strategy to acquire deal flow. So it's like thinking outside of the box, stop giving and just regurgitating everything that we see. So it actually is going to cut through the noise.
Yeah, and that authenticity piece. Like going back to Peter Ellis's feedback about our podcast, the human nature of us and sharing all our messiness, incompetence and everything else is part of what is drawing listeners in. Now, whether that converts for us into deals done and dollars invested and everything else, time will tell. But authentic, real, getting to know the people behind the business, not just a polished production that's actually pitching something. And Jack, every piece of short form content you send through, I feel like I want to sign up for. So it's absolutely effective. Even things that I probably don't need. It's just that short form video content with a strong hook. It gets me.
Yeah. The thing about short form is within 7 seconds, you can get credibility, trust, and give them a call to action, where it's much harder to get that in a static ad or a written post or a long form video. So that's why I like it. But like what we're learning for some of these things, like LinkedIn may not actually appreciate short form. So you just got to find other ways. But depending on B2C, B2G or B2B, there's different ways and you've just got to be smart and work it out.
On that, Don, can you share your most viral post on LinkedIn today?
I was about to just say, Jack, I'm never going to stop stealing other people's memes and pointlessly posting them. As long as we've got that understood between us. But yeah, just how pointless or hard to understand this LinkedIn co is. I just posted like this SWAT team trying to bang down a door with a bar, but this door is obviously just so reinforced and they just keep banging at it. And then one of the guys tires out and the next guy has a go. And it's like almost a comedy of errors trying to bang down this door. And I just did a little post that said what it feels like when you don't, the sales process when you don't have product market fit, right? You're just trying to bang down a door that nobody wants you to come through. And it got like my normal level of engagement with my funny little, that I think funny. And then something happened in the algo. And I think all the normal people engaged in it. And there was a couple of comments, but then it was like, there was a couple of third connections that were connected to seconds and then my first. And I reckon there must've been someone in LinkedIn that just hit a switch, because then it went from like 3,000 views to 5,000 to 10,000 to 15, 20, 30, 40, 50, 100, 130. And I think it's like at like 160 now. Totally pointless, because then the people that are commenting on it, like one person's like, can you tell me who the door company is, please? It looks like a really good door. Like someone like no one from at a certain point, they weren't from the network. There wasn't any value in it. It was just all this randomness. And so it was just a good lesson in just the absolute vanity of thinking that impressions actually has anything to do. And it's the same with this podcast, right? I'd rather have 50 of the people that we really want to help, that we really want to communicate, that we really want to engage with, than 10,000 people that don't see any direct value. So yeah, I'm not going to stop, Jack.
No, I think memes work. So why stop if it works? I have a theory why that one popped on. So I think someone behind LinkedIn was like, this poor bastard's been grinding 50 days. He's only getting 100 views. Like, we'll give him a treat. See if he keeps coming back. Yeah. I know it was his birthday 2 weeks ago. So how good. Happy birthday, Don. 57.
Just like the pokies. Like, it just keeps you enough to like almost give up. And it's like, oh my God.
Should we do some rapid fire updates from the market in terms of recent rates?
Let's do some rapid fire raises. So Startup Daily has some really good links in there. So 3D fashion startup Bandicoot Imaging Sciences banks $1 million in a pre-seed round. Bandicoot Imaging had previously raised $330,000 in July 2020 in an angel round.
Yeah. And Kismet, which I think we saw at one point, but they just raised 8.2 million in a seed round, actually 12 Australian, 8.2 US. And they're a healthcare platform focused on NDIS.
Yeah. And Airtree, Black Note and Flying Fox were part of their original seed.
Yeah, there's a good story there. So the founder was actually a second time founder, and Airtree backed him the first time it was in a childcare space, Don. So he had one of the CRMs for it's Explore. You might be familiar with it. It's like the main operating system for childcare.
I use it with the kids after school care.
Yep.
Yeah, interesting. But that's like, it's great to see when a VC and partners with a founder have a great outcome the first time, and then they double down and back them the second time.
Yeah, keeps the machine moving. And then Wellness Advice Marketplace banks $1 million in their seed round, and that was after 5 months after launching.
Yep. And a Victorian startup out of Monash University has raised $9 million to develop carbon neutral green ammonia for the ag sector. We're seeing more of these. Yeah, we're seeing more and more of these come through now.
Yeah, there's the intersection of climate tech and ag tech, like just a lot of stuff happening there. That's really, really exciting. And so those were some raises, but there was a post out this week from Peter Walker of Carter, and he put out some data that showed what the average time was to complete raises at different phases from incorporation. So the data he put out that the average time from the point that you incorporate for a seed round is 1.6 years. For an A round is 3.3 years. For a B round is 4.9 years. C round is 6.9 years. D round 8 years. And E plus 10.4 years. Now keep in mind that these are the averages. So as we saw with one of the announcements there that raised their seed round 5 months after launching, that's at the early phase, and others take longer. But I thought that was just interesting the way that data was broken out. And he provided some charts just showing that it's getting longer. So if you go back a few years, those times were actually shorter.
Yeah, and that's interesting. Let's try and interpret causality in that. Is it because we're going through this phase where companies have come back to business fundamentals, needing to come back to profitability or cash flow positive, and therefore don't need to raise, or avoiding raising because of the market? Or is it genuinely that it's taking longer to hit the milestones to actually raise? So it's interesting to try and understand the causality, but I think it's pretty consistent with what we've been seeing, particularly over the last 18 months with companies coming back to fundamentals and kicking the can down the road on any potential down round and trying to avoid going back to market.
Yeah, building a healthy company that's tested all different parts of the go-to-market funnel, that has a bit of a machine going, that then can demonstrate how it's going to use the capital. That just takes longer.
And the era of resourcefulness over resources.
Yeah. And one of the things that we're seeing, whilst the average time to raise is interesting, we are seeing more and more employee share and option plans, ESOPs, become just adopted at a greater rate. And shout out to Kim and Cal from Cake that were down at Southstart this year. It was good to see them. Dan Van Boom of Capital Breif put out an article, ESOPs Fable, the startup sector's most glamorous and misunderstood acronym. Large secondaries by Australian startups like Canva have raised awareness of employee stock option plans, but experts are warning founders that poorly designed schemes can make life difficult for their startups. And I think that headline is absolutely correct. That's why we've backed Cake. We think that it's a really important thing for the ecosystem to use as a tool, but if you don't get it right, it causes pain.
Yeah, cap tables are not fun. And even when you have a small number of shareholders or investors, it gets complicated super fast. And introducing an ESOP, if it's not done right, is problematic. And making sure you're actually incentivizing staff, and then all sorts of variabilities in all of that, like all the alternatives of how you structure it, what clauses you have. So yeah, shout out to Kim and the Cake team for what they're doing to simplify that for founders.
And I think the volume is going to continue to pick up, that as companies like Canva, Safety Culture, as the ecosystem sees more of these big companies actually getting value out of those ESOP plans, I think you'll find more and more people get on board with them. But taking parts of this article, are ESOPs worth it? It's a retention mechanism, says Alex Mitko, former CFO and current advisor at Eucalyptus. Some people can't afford to exercise, so they have to stay in. At Eucalyptus, we don't think it's fair to do that, so our plans don't have those clauses. So what he was saying there is the way that a lot of these are structured is that you've got your strike price on your options. If you're converting and selling the same day, you don't have to worry about it, because that's just cash in, cash out, and often the tax will get deducted. Whereas if you want to leave, a lot of the clauses, even though you've earned them, they force you to execute there and then, and you've got to then somehow find that cash, and that can be difficult. Are founders assholes? He asked. You need to know, because it does reflect how they potentially implement and administer the plan. I wasn't exactly sure that was the most helpful comment, but I don't believe the majority of founders are assholes. What I do think is that in the early stage, when you put these things in place, you don't contemplate what life might look like at the later phase. And then you've got a plan that looks like X, and it's quite hard to change. Some people may then perceive they're being treated like, or they're behaving like assholes, but sometimes your hands are tied.
Yeah, I thought that was a bit of a random comment, because if the ESOP is set up, unless the ESOP is set up in a way with a lot of variability, usually they're pretty clear and pretty well defined in terms of bad leaver clauses, good leaver clauses, buybacks, termination periods, all these sort of things. So vesting periods, hopefully it's well documented, but I guess there could be situations where, yeah, there's a lot of discretion in how that gets managed.
This can be documented, but you might not understand the consequences of it until you're actually in it.
That's true.
I think that's one of these things that you signed up and you went, yeah, ESOP, yeah, that makes sense. Yeah, I'm going to be here forever. Love it. And then, I don't know, personal circumstances, kids,
yes,
spouses, whatever it might be, right? Something happens. And now you're in a situation where you're contemplating, oh, I can't stay here. I've got to go do something else. And then suddenly something that you may have intellectually understood and signed up for, you've now greeted with, I've got to find how much money in order to keep my options and not let them go.
Yeah, it's very true of shareholders agreements too. Like you set these things up when everything's good, happy and rosy. And it's in the moments where things get tested and go sideways that you discover, oh, wow, I wish that clause had been different when we documented that. But it's all one thing to have options and to then execute on them and have some shares in the company. But hopefully the employees can also get some sort of liquidation at some point. And the other thing we're seeing, and that these articles have touched on, is the rise of secondaries and the continued prevalence of secondaries in the market as well.
Yeah. Nick Bonyhady of AFR put out an article that startup that delivered Australian founder 250 million goes into liquidation. And what this article was, a company called Hopin, which made video calling software for events, attracted funding from big global venture capital firms, including Tiger Global and Andreessen Horowitz. At the peak, its valuation was 11.7 billion Aussie, which was 7.7 billion US at the time. And what Nick points out, the founder, Johnny Buffahad, who was born and raised in Sydney and then went to live around the world with his family, he took out what this article says, 130 million pounds through those secondaries, which is 250 million. And the article just describes it as a controversial part of startups because some argue that it rewards success that only exists on paper. So without getting into Hopin, and I don't fully understand the story, but it sounds like another one of these COVID era companies that raised a lot of money, but underlying it didn't have a functional business model or whatever led to it. But what do we think of secondaries and founders and teams taking cash out?
Yeah, I think the article by Nick it's a good one for this conversation because that's a lot of capital to be taking out of the company. I think secondaries, if a founder is under financial stress or has whatever going on in their life, taking a small secondary to resolve that stress point and ensure that they're emotionally focused on the business, that's a really healthy outcome. I think what we touched on last week in the potty though, is where you see a secondary come out and it's also timed to a cap raise or something else. It's like, oh, we're doing really well. I'm just going to take a little bit off the table. Oh, but meanwhile, we need some extra capital to keep us going. I think that's a bit of a red flag or a cause for investigation. But look, I think if done well and transparently and when the company is at the right point, I'm all for some secondaries. I understand it. I think it's great seeing it now at this stage of life cycle of Canva where employees get some benefits of the secondaries too. I think that's really healthy.
I think secondaries are super important, but like we were touching on yesterday, Don, it's balancing the incentive. And from an investor's point of view, like we need to make sure that everyone's rowing in the right direction and the incentive is right. So it's just balancing that for the founder, because obviously you don't want them to be slaving for 10 years on just a fair salary when they should take some capital off the table if the time's right. But you'd never want it to be too much that you're questioning whether or not there's the right incentive for them to keep driving this company forward.
Yeah, I'm sort of all got to be in the same canoe kind of basket, especially where we invest and the risk profile. And if the founder has gotten to a point where they've run out of steam for it and they'd rather be taking their capital and doing other things, or the distractionary opportunities that capital brings, it's time for us to all get out of that canoe together.
Yeah.
And that's the way I look at it. Everything within region. I don't want our founders to be so stressed out and can't cover basic things. And that's why I'm a big supporter of at the right time, like when the company has a level of health and is able to produce cash and is able to move in the right direction, but within reason. But this was a COVID era. 150 million was probably a rounding error in what was raised. I don't know, but I don't think it's black and white. I don't think we're in every situation for it or every situation against it.
It's interesting too to think it's not the only mechanism, right? If the company is doing well and dividends an option, and chatting to Mick Dempsey with Easy Debit, the shareholders took a lot of dividends out of the business over the years. And one of the questions he always had was, should we be reinvesting this? And if he had, it likely would have been a significant higher valuation when they sold beyond the 305 million that they got. But his view was, no, this actually de-risked it and investors got returns as they went along. So to your point, Don, about we're all in this boat together.
And even at Southstart, talking to the other investors, compared to prior years, just the focus on returning capital, we are also laser focused on what are the opportunities, not for the big bang stuff, but a bit here and a bit there. This industry relies on recycling of capital.
Yeah.
So whatever happened at Hopin, and we're not fully sure, we haven't dived into it, but I would suggest at very least we can say that it didn't cross the chasm And the chasm, as we know, is the tech diffusion curve, where you have your early adopters, and then there's this really big chasm where most companies die because they're unable to jump into the early majority and then the late majority, which is really where scale and sustainability comes. And there was a great post by Anthony Pieri on LinkedIn. And what he was talking about before getting into the crossing of the chasm was, why do I have to pick a niche, say founders? Slack didn't pick a niche. And I found that intro quite interesting, because it is true, there are these products out there that look like they don't pick a niche. And often founders that we're suggesting that need to go a niche, they will always go and pull that.
Well, first of all, just to quickly explain the diffusion curve for those that might not be familiar, it came from the work of Rogers, and it's basically just a way of describing, like, breaking down different behavioral patterns in terms of purchasing within a customer segment. So typically we see this early adoption of new tech from these groups that are called innovators and early adopters. So innovators just love the tech. All they care about is the latest feature. I just want the latest gadget. I care about the tech. Then you've got the early adopters, who are the influencers. They want to be seen with the latest techs. I'll just use that catchphrase, thought leader. Like they want to be positioning that way. And the problem is then there's this chasm, this gap, because the rest of the market, which is the majority, actually needs to see real value in order for them to make a purchase. So it's not about the product. It's about, what the hell does this do for me? And so that early majority that companies, you need to sell to that early majority, but they need to see a demonstration of value. And the problem is, where we see this play out is tech founders who love their product. They fixate on the product features, and that's their messaging to market. And they attract these early adopters and innovators, and they're getting revenue, they're getting growth, and the charts are going up and to the right. But then they don't understand why they then fall off a cliff and they're not converting. And it's because they haven't demonstrated an actual value prop to the rest of the majority of the market. And we've seen this play out in AI, in the B2B. Like, new AI products come out, and there's that champion internally inside the enterprise or the corporate that's signing up, and they're getting traction. But what we've seen recently is those budgets, that discretionary spend on AI tech, has dropped off, because while it was fun to play with and it was a cool gadget, it didn't actually deliver value to the enterprise. So they didn't get that mass adoption. And so when we talk about niching, the reason for niching to cross the chasm is and we see that play out in the markets, right? You go to the UK, you have to get that big logo brand in a POC, like an initial contract, even if you don't make money on it. So you've got that credibility. So then those early adopters can see, wow, demonstrated value. You actually achieved this outcome from Barclays. Here's the case study. We can see the ROI. Now those in the early majority through to the laggards will actually come and purchase, because you've got that credibility. Now, if you're not niche and you've got one of them in one sector and one case study in another sector and a case study in another sector, you're diluting that message. And so when you niche, you can have a more targeted language.
In most cases, you don't get all those case studies because you weren't niche to begin with. You don't have that focused message. So you end up not actually getting those, which then means you can't get to the next step. By having that real niche, especially when going offshore, you can then get message to market fit, which is what we did the workshop on at Southstart. And if you can get the message to market, best way to get a message really fitting really well is when you understand the customer perfectly. And to do that really perfectly, it's going to have to be quite niche, like their specific issue, their specific desire. And that's how you then get that beginning of, okay, now I can get that logo, then I can cross the chasms.
Yeah. And where we see it play out is when a founder says, we're solving this problem, and that problem exists in this sector. And they claim to be focused because they're so targeted on only those that experience that problem. The problem with that is that it might be targeted in that way, but it's not targeted in terms of the channels, like where those people live in different sectors and how to reach them. What they measure ROI on could be totally different. But the words that they will use will be totally different. Like to your point, Don, the language of how that gets pitched is completely different when you're talking to someone in agriculture versus insurance.
Yeah, the problem may be the same. It's like at a high level, but the wording of each of the the problems for each of the sectors or the ideal client, or even within the companies.
We talked about the new Apple headsets and their price point creating mimetic desire. So that's that concept that when you see someone you respect with the product, it makes you want it even more. And it's true in the corporate land. If you can get that initial logo client that others respect, and also you can demonstrate, they articulate the value in the words of that client, that's more likely where you'll cross the chasm. And so a couple of just quick points for founders. How do you know what type of customer you have in terms of the diffusion curve? Go and talk to them, like ask them. And if you ask them what they love about what you do and what's the value and all that, if they're talking about the product and the features of the product and how sexy and cool the tech is, then more than likely you're in the early adopters and the innovators who just love the product and you haven't actually crossed the chasm. But if they're talking about how amazing it makes things internally, or the value in the P&L that's derived from it, or some real value proposition and not even the product at all, chances are you've got some customers at least in that other side of the chasm. So you don't have customer conversations.
What Anthony says in his post here, the reason you can only do this for one niche at a time is because each segment needs different sets of requirements beyond your software itself or beyond your product itself. And no small startup can deliver multiple different whole products at once. What's been interesting with Southstart is just a reminder of some really passionate, great founders that we've come across. But in talking with them, I'll always start with, okay, what's the problem that you solve? And if there's more than a 3-second pause, I know we've got a bit of a problem here. Because then what starts to come out is all these different problems, or it's a bit complex, or, well, this is the problem. I said, does the customer think that's a problem? Oh, no, the customer doesn't know that's a problem.
Yeah.
What would the customer say? Oh, they don't really know. So actually, we need to understand the customer's language, what they think is a problem. Then when I ask, okay, if that's the problem of the customer, say, well, what's your product? Then they stumble a little bit and it does this and it does that. But actually, when you get to the core of it, is they're just trying to go too wide, too broad, try and do too much. They're not getting niche. And well, one of the things we keep finding is when people have an indirect product, like if you buy my product and do these things, you'll get this indirect performance outcome. That's a really hard world. That's like coaching, consulting. It's trust me. And if you do this stuff here, then you might get a performance thing out there. Whereas direct products, things like I've committed a crime somewhere. I need a lawyer, right? It's the direct product, and the outcome, it's I'm either going to jail or I'm not. You just got to compete as to why you're the lawyer to choose, but there's no ambiguity as to why people need you. Whereas in the indirect world, that's where niching can help, is to move more direct instead of in this indirect soup.
The other challenge with the indirect is often the budget that you're selling into is different to the budget where the benefit ends up. So you're trying to convince someone to use their budget for some other division's benefit. The other one we talked about at the workshop, Don, was those that go out and validate and confirm and discover this problem, and everyone has it. Everyone experiences this problem, but it's actually not big enough for anyone to give a shit about actually doing anything to solve or pay for.
Yeah, one partner said everyone says there's a problem, but they just won't pay any money for it. It's like, okay, it's a different problem. And I don't want to be negative Nelly, but this is, if you're ever going to pivot, these are the kinds of conversations where pivots happen. Because if you think it's a problem, but your customer doesn't want to pay for it, good luck.
Yeah.
We'll put that article in the show notes. We're running out a bit of time because we've got to go hit a couple of wineries. We're going to go chill. Yeah. Hashtag. Jack's driving. I will admit, Jack, because the amount of dust with the heat and the wind, my hay fever went crazy last night. So I didn't get a lot of sleep. So I will be having a sleep in your back seat.
That's all good, Dom.
The young bloke's driving the old bloke around so the old bloke can have a nap.
While we've been talking, I did get pinged by Elizabeth Farley, and shout out to Elizabeth who's in market, asking if we had a spare seat to drive her out as well. So might be thoughtful. We're all asleep.
All right, Jack, we'll see you soon out the front.
Sounds good.
Yeah.
See you guys soon.